Welcome to Looking at the Markets with David Moadel. Today we've got a chart master, a chart ninja, a chart expert, one of the premier ones. I mean, I've been so fortunate to be able to tap into the insight of great traders and investors in all areas. You've got your fundamentals guys, you've got your commodities experts, gold and silver guys I've been speaking to a lot with lately, and that's been wonderful. But I love a good chart, and Mr. Dana Lyons, he's one of the premier chart guys. He's highly recognized on Stock Twits, Twitter. Mr. Lyons is a partner at J Lyons Fund Management Inc. He's the founder of my401kpro.com, editor of the Lyons Share, which is located on the web at lyonssharepro.com, and he is a registered investment advisor. He is also a regular contributor to See It Market and Yahoo Finance. Dana's charts are highly recognizable, accessible to traders and investors at all levels, and backed by plenty of research. Thank you, Dana, for joining me today.
Oh, my pleasure. Thanks for having me, David.
Sure, absolutely. So let's start at the beginning, if I may. What is your background in stocks and finance in general? And were there any mentors that you'd like to give a shout out to?
Yes. As a matter of fact, I've had an interest in stocks and data and charts specifically since my memories begin. My father came up through the business, started with Merrill Lynch back in 1969. So he started right at the beginning of a long secular bear market. So his christening was to get new clients and put their money in the market, only to see it wiped out immediately, and then build back up and wiped out again throughout the course of the next decade and a half. So his background has basically molded my concept and my thinking of the markets. Specifically, he realized basically halfway through that 1970s market that markets do indeed go both up and down. It's not a one-way street. Notwithstanding the markets of the last few years that have seemingly just been a one-way market, but that has molded my thinking and has really aided my approach, especially during the 2000s period, when the market, when we had a couple really bad cyclical bear markets. So I think whereas a lot of people coming up in the business are geared towards the mindset of just buy, and get your money in there and stick with it, buy stocks for the long run, and et cetera, et cetera. I've been brought up with the mindset that the market goes up and down on a regular basis, on a regular cycle, and I think it's a healthy mindset to have.
Yes.
Especially there'll be periods when being a raging bull, buy every single dip is going to serve you well, but eventually that rug will get pulled out. So I think it's a good mindset to have that risk conscious focus, at least at the back of your mind.
I totally agree. For me, the trade or investment is won or lost before it's even made, and mindset, that's such a great word that you used. It's so essential. Before I forget, I just want to give some time to the services that you offer. What services do you offer at the Lyons Share, J Lyons Fund Management, as well as My 401k Pro?
Well, J Lyons Fund Management is our registered investment advisory that's been around for over 30 years now, and we manage money on a discretionary basis. It's a fully managed assets firm. So folks hire us to take the investment task off their hands, and we do the entire job for them. And we use, in that task, we use a couple tools. We use a risk model that generally guides our posture towards the market, whether we're bullish or bearish, whether we want to be, aggressive or defensive in the market. So that's one leg. The other leg of our investment philosophy is, where do we want to be invested? So we have another quantitative model that I developed in trying to guide us towards those sectors that are areas of the market that are performing best and are likely to continue to perform best. So we want to be in the market at the right time and in the right places. And with the second product, my 401k Pro, which we launched about a dozen years ago, it's an online subscription service geared towards retirement investors who 401k investors especially have no access to real, risk managed guidance or help, because the 401k system makes it very difficult for them to access outside help, and it makes it difficult for advisors or brokers or anyone to access them to help them. So what we did was build this service, my401kpro.com, wherein we provide some of the risk management tools that we use in our management practice in terms of deciding when to be invested and where to be invested. And we provide the tools online for subscribers, a lot of IRA investors and 401k investors. So we'll take the actual funds in their plan, or if it's an IRA investor, whatever funds they want, and we'll rank them according to our models, and continue to update those on a regular basis and kind of provide the risk management tools for self-directing investors.
Absolutely. Yeah, absolutely.
Yeah.
And just to let you know and let everybody know, I will be putting links to all of these websites and services in the description of this YouTube video, and we'll give you an opportunity toward the end to mention your contact information once again. That's the Lyons Share, J Lyons Fund Management, and 401k Pro.
And the
Yeah.
Oh, excuse me. I was going to say lastly, the Lyons Share we just launched about a month ago, and that was basically born out of a lot of the charts and research that we share online, and we have for the last several years. We've received more and more demand for more and more analysis and material, because basically we do like a chart of the day on Twitter, StockTwits, and then we'll write a blog on it and get it out there. And what happens is people tend to take that one data point and mold a whole investment thesis around it, when it's just one small part of a complex strategy. So we launched the Lyons Share to another subscription service to kind of give members the more complete picture. So we provide daily updates of our macro market outlook, and an extensive weekend update as far as that goes. So it gives them more of the whole macro picture of our outlook on a daily basis, rather than just one snippet or one chart.
Yeah, I'm glad you mentioned that, because as amazing as Dana's charts are, we never want to base our entire trading or investing strategy on just a chart. It's a piece of a bigger puzzle, and going over to the Lyons Share absolutely will give you the bigger picture, as well as really great strategies and ideas for subscribers. So we all definitely want to check that out. So let's talk about seasonality. From what I can tell, you're a big seasonality guy. How can traders and investors use seasonality and historical trends to increase their returns?
We don't incorporate seasonality necessarily into our models. There it is. I will say, of all the quantitative or quantifiable systems, investment systems that have been developed throughout the years, some of the most effective have been seasonality based systems. So that has that is certainly one way in which someone can augment their investment returns, is paying attention to seasonality, whether it's cycles, long-term cycles, short-term cycles, based on the calendar, based on, trading around holidays and that type of thing. That certainly can augment investors' returns, paying a close attention to historical, trends and cycles there. I think it's part of a larger concept, which you allude to, which is just paying attention to the historical trends, historical norms, and research, searching for different cycles and patterns that repeat. Because in the micro term, in the short term, obviously markets are always evolving. The markets are a lot different in the short term now than they were even 10 years ago, especially with all the algorithm-based trading, the high-frequency trading, that type of thing. So in the short term, in the micro term, things are a lot different than even a decade ago. However, at the end of the day, over the course of a 4-year cycle, or even a 4-month cycle, or something of a longer term nature, the markets still generally cycle like they always have, because the one thing that doesn't change throughout time is human nature. So the one thing, markets will always be subject to a buildup of bullishness or greed, if you will, up to a certain point. And when you reach a tipping point, then it goes back the other way. The pendulum swings back the other way until you get enough fear in the market where it comes back. So the one thing in studying historical trends, historical cycles, the one thing that gives us confidence that these types of things are useful in helping someone in their evolve or produce their investment strategy is it's all based on the same type of things. It's all based on human nature, human natural reactions, which goes into supply and demand. So no matter how technological advances, what technological advances come about, it could be all robots, assisting traders, in a couple of years from now, but it's still going to be humans building those systems, and humans at the end of the day hitting the buttons. And the one thing that will never change is human nature. So I think as active managers, as rough a time as a lot of active managers have had in recent years, I think they can take comfort that human nature will always be a factor in the market, and will always have create a spot for them in the marketplace.
Very true. The more things change, the more they stay the same, and that human element the human element is a big part of that. Now, I am a big fan of your charts, as many people are. Now, what makes charting such a powerful tool for traders and for educators such as yourself? And what can charts convey that raw numbers and statistics cannot?
Well, I think it's a couple things. It's attractive to me, because I'm a visual person. I like to visualize things instead of crunching numbers and necessarily, although I do a lot of that. And then B, I'm also lazy, so I like to look at a picture. As they say, a picture is worth 1,000 words, and the same thing with a chart. You could see a lot just looking at a chart that isn't necessarily evident if you're reading a ticker for the trades of the day. That doesn't show you that doesn't tell you much unless you're a computer. So charts, again, I'm a very visual person, and you can chart is a picture is worth 1,000 words. So you can tell a lot about it, a lot about a market, about the trend, etc., just by displaying a chart. So it makes it's an attractive way of us for us to present some of our ideas, some of our research, and B, it's an easy way for, like you said, for followers, for observers, for participants to accept kind of data or analysis, because they don't have to pour through, a research report, a balance sheet, that type of thing. It's an easy thing to look at and dissect. That said, we don't want to suggest that it's a simple that charting and its respective analysis is like a simple procedure, is a simple way of making money or buying or selling or anything like that. It's still complicated in its execution and its practice, and we don't want to suggest that you as a follower or observer, you look at a chart and what's going to happen in the market. It's not that easy, but I think you can just convey a lot of material, a lot of analysis through a chart that would take you a lot of words, a lot of writing, just to present what you can in a simple picture.
Absolutely. I'm an educator myself, and there's so many visual learners, and I love your charts because they convey so much research, so much back testing, in a simple format that is so accessible to so many people. That's what I like about it so much. Now let's talk about when things go wrong. What methods do you use to hedge your trades in case they go against you?
Well, the overriding, we're risk managers at heart, so we're always conscious first and foremost about risk and not taking losses, especially as we manage other people's money. So it's one thing to lose your own money, but it's another thing when you're losing, especially retirement money for your clients, which we don't want to do. So by nature, we're risk conscious to begin with. But the overriding risk control that we have is this risk model that we've been using since my father developed it back in the 1970s. It's largely intact since then. It basically what it tries to discern is the overall direction of the broad market. So where are most stocks going up or down? Because the research has borne out that about 70 to 80% of the direction of a stock will be dictated by the movement of the broad market. So if the whole market's going up, most likely your investment's going to be up, and vice versa. So our risk model keeps us in tune to the general direction of the market. It certainly can be wrong at times, but as it's measuring the data just derived from the market itself, it can't stay wrong for very long. So that is our overriding methodology for controlling risk. After that, we also have various charting techniques that we use for specific positions, whether it's different chart levels to stop us out when it's evident that a trade goes wrong. So that's on a micro level, but we have various levels of risk controls at all times. And as Warren Buffett says, rule number one is don't lose money. Yep. In the market, and rule number two is don't forget rule number one, and we are proponents of that.
Very important. Capital preservation, objective number one. I like that a lot. That absolutely makes me feel better as a trader and investor, and for all anybody interested in the J Lyons fund management and my 401k Pro, that's got to make them feel be able to sleep at night and feel better about the active management that they're getting from J Lyons, from the J Lyons fund. Absolutely. Now let's look forward a little bit. So far, 2017, the Trump trade, the bull market is still intact so far. How will your trading strategy be different as we progress throughout 2017? And will the new presidential administration require us to trade differently?
Uh, from our perspective, nothing will be different. We have quantitative models that we follow based on the data, and we'll continue to follow those quantitative models. So we try to be completely objective. Actually, we try to ignore the news. Obviously, there will be events like the election that will bring about price movement that you can't ignore, or the Fed meeting the other day that'll bring about price moves that obviously you can't ignore, and those feed into the data that we're reading and dissecting. So, but in terms of qualitative or subjectively altering our investment approach, it won't change it a single bit. We're still going to be quantitative and follow our models. And the great thing about the stock market and the markets in general is they are the single best discounting mechanism in the world. They can filter every bit of information in the world in a nanosecond, and much more efficient than we can, or anyone can on their own, taking a slice of data here and there. So if you read the market, if you read the data, that will tell you generally what the impact of any event's going to be, or what the cumulative impact of all of the events and all of the trader input throughout the market, what the ultimate conclusion will be. That's all going to be filtered through the market. Excuse me. So, from that standpoint, we don't change a thing from our investment strategy. We remain completely quantitative and objective, and if there's going to be a further upside in the market, whether it's based on Trump or not, that will be borne out in the statistics. And if we're going to be headed for trouble, whether journalists are going to ascribe it to Trump or not, that's going to be borne out in the data as well. So we're just going to continue to read the data and our indicators, and manage money and manage risk just as we always have.
Absolutely. That is, in my estimation, a strategy and a recipe for success. Stick with the data, stick with the information that's in front of you. Don't try to follow the trends of the day. And that really works for me, and it's obviously working for Mr. Dana Lyons. Just another thing I wanted to address as an educator, and you're an educator as well. Why do you think so many retail traders fail at it, and how can we fix this?
Well, there are any number of reasons. The allure is out there. It's so easy to get out there and open a trading account. It's like opening a gambling account. It's like, why do so many people gamble? Because it's easy to, and the allure is there, and especially when the market's gone straight up for 8 years. People want to get in there, and unfortunately, like we were discussing, the human natural element of the market, at market tops, it's going to suck the most people in, and conversely, at bottoms, people are going to bail out. But that's the unfortunate thing about the human natural element of the market. It's going to suck people in right at the top, and in general, I think most people fail at trading because it's a highly emotional, not game, it's a highly emotional task, and either they don't take it serious enough by developing a systematic strategy to follow that'll guide them, when things get tough, or they do have a system, but typically what happens when the going gets tough, they let emotions override their system, and they make what seems like the right decision, but inevitably human nature will make you make the wrong decision at the wrong time. So it's like I always say, if you're not going to hire a good risk manager, active manager, sure, go ahead and buy and hold. That's not what we would do, but at least if you're buying and holding, you're not making the wrong decision at the wrong time. you're going to take what the market gets you, and that's better than buying high and selling low. The problem is when we get to the lows in 2002 or in 2009, people subvert their that buy and hold strategy, and they say, look, I've just lost 40-50% of my retirement money. I can't take it any longer, and they bail out right at the bottom. So even a passive strategy is very difficult to maintain given the emotional nature of the markets and investing or trading. So I think that's why most people fail at trading at markets. I think it's probably why a lot of people fail at a lot of things. It's a difficult task overcoming those human natural feelings.
Absolutely. Buying high and selling low. A lot of people do it, and I think that's
Right.
I've asked that question to many people, and the answers seem to be pretty consistent. The tendency of people to gamble with their money, especially when markets are toppy like they are now. The tendency of people to chase after the price action, which does mean buying high and then selling low. And you alluded to something that's so essential, which is, you may think buy and hold is the easiest way, but it sounds easy, but actually doing it, actually riding out those 50% drawdowns in the markets, not so easy. Not so passive, not so
Right.
easy. Absolutely. And for many people, I think active management, finding somebody such as Mr. Dana Lyons who can actively manage the funds using data, using information, using extensive back testing and research really is the way to go. So I wanted to thank you so much for all this insight and so much food for thought today. I wanted to give you another opportunity to let people know how they can contact you either through your websites or StockTwit's Twitter or any other means.
Sure. I would go probably first and foremost to our new product. It's the Lions Share. You can find it at lionsharepro.com, and Lions is Lyons. You can use the contact form on that page, or you can email me at info@jlfmi.com. JLFMI stands for J Lyons Fund Management Incorporated. You can reach me that way, or again on Twitter and StockTwits. My handle is J Lyons Fund MGMT. So hopefully, David, you can put this info up, and feel free to reach out and ask questions about any of the products or the markets, and I am happy to engage, as you'll see on various outlets and social media. Have a good time, and by sharing, we all get better at this task. The more we share and the more we engage. So I didn't know exactly what I was going to get out of this whole social media campaign when we started about 4 years ago, but I think I've gained as much just personally from sharing as maybe others have gained from me by the content that we put out there. I've become a better manager and better, more in tune with our approach and our strategy. So feel free to engage, reach out, and be happy to have a dialogue.
Absolutely. And I hope that people will take advantage of that and take advantage of your services. People have gained so much from your charts. If everybody listening to this is not at the very least, on Twitter following you, on StockTwits following you, and contacting you for questions, advisement, and further information, then they really need to be taking advantage of that, because Mr. Dana Lyons is quite a resource, and you've been very generous with your time today. I want to thank you for joining us here on Looking at the Markets. Mr. Dana Lyons, thank you so much today.
My pleasure, David. Thanks for having me.
All right.